and we'll go ahead and get started. So welcome to today's Monday morning mortgage message. My name is Sean Woland, and most of you guys already know me. So hello, how you doing today? September sucked. I'm just going to say it loud and clear. September was a bad month from the day it started. It was every day rates got worse. Um, it was rough. It was rough. Inflation numbers were mediocre. I mean, just everything that we could have wanted to help rates get better, it was the opposite. Jobs numbers were strong. It was just overall pretty rough. So if you look on this graph, this is the 30-year Fannie Mae 30-year. This spot right here, this was September 1st. We rallied at the end of August, and then September 1st hit, and then we just dropped, and we had a consistent kind of a meltdown. We hit a floor right here. We bounced up, and then we had a little bit of what we thought was a recovery here. And then this morning, we just dropped all the way back to this lower level here. So if you look at this low level here, this 98, this price of 98 on the Fannie Mae 30-year, it was a long time ago where we hit this level. I'm talking 23 years since we have hit this level. So mortgage rates are at their worst level in quite some time. It's tough. I was just watching the news, and they're talking about the bond market right now on MSNBC. There's a bond trader that's on here, and quantitative tightening is where the feds are selling off the balance sheet. Okay, so they had 9 trillion on their balance sheet. They sold off a trillion. So now we're at 8 trillion. So they sold off a $1 trillion worth of bonds in this last 8 or 9 months, which is a lot. They've never sold off this much, so they don't really know how much of an impact this is going to have on the bond market. And what we're kind of seeing is what that I talked about earlier, that tug of war between inflation going down and quantitative tightening. So if you remember, back in 2020, the government was buying bonds in large amounts, like billions a month. Now we're selling them. So when we bought them, mortgage rates are dropping quickly. Now we're selling them, so mortgage rates are increasing quickly. So that's what quantitative tightening is. They're tightening the money supply. They're removing all of these bonds from their balance sheet. So that's part of the process of what's happening right now. So it's a tug of war because we see inflation coming down. The feds are working really hard for that. But we have this quantitative tightening, and then we have the job market that's still very resilient. So it's kind of tough to watch. It hurts. So my focus right here is to really work on your cash buyers right now and keep your buyers that have mortgages, just keep them on the hook and focus really heavily on rate buy downs. We really have to change the psychology of them right now because the news, everything is saying high rates, how high can they go? And it's a little bit disheartening to watch that. So let's have a look at this. This is the 30-year back in February. This is the trend line. If you can see this trend line, it's just, oh, there we go. Whoop, there we go. We were up here, and it's just been a down, then up, then 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 down. And then we may see a little bit of a rebound here. Let's hope we don't get any further than this. There is some hope on the horizon. We do know that inflation is coming down. We have a lot of these bond traders being speculative at the moment, and they're kind of they're not all agreeing, which is a good thing. Some feel that the bond market is going to rebound, and as we get into this fourth quarter and into next year, we're going to start to see the reversal of the economy as far as numbers go, and the jobs numbers, we're going to start to see those kind of weaken a little bit, and that's going to be the first glimmer of hope. So what do we want for holidays? What do we want for Thanksgiving and Christmas? We want unemployment to go higher. I mean, that's terrible to say, but in regards to mortgage rates, that's exactly what we want. So we have big jobs numbers coming out this week, and let's get into kind of where we are. Here's the 10-year. we're up against the ceiling of resistance and we pierced through it. So now the 10-year is at a high. It's at 4.68. Some believe that's going to get to 5 before we come back down. I really hope that we don't continue to climb. This quantitative tightening is going to really be pushing bonds in a negative way on the long term, and the short term, the 10-year, I think we're going to still see this kind of climb a little bit. So it may be rough for October. It's my birthday month, so what I want for my birthday is mortgage rates to come down. Don't know if it's going to happen, but today, I mean, we lost 58 basis points today, guys. What that means, what that translates to rate, is between 1/8 and 1/4 in interest rate we lost just today. So it's tough. It's tough. So where are rates? Here is a really good breakdown of what rates are doing right now as far as average. This is based on a 740 to 760 or 759 credit score. We're at 8 for the most part. And what I want to show you is, I'm going to move out of this real fast. I'm going to show you what mortgage, how mortgage rates can change real fast. Mortgage calculator. Oh, mortgage rate, sorry. This is a really interesting calculator. This is the best one I've seen so far, and Google has put it together. This shows you the what interest rates, how they change based on credit score. So if you have 20% down and you have a 700 credit score, you're in the 8s. This credit score makes a massive impact. Let's change that from 700 to 780. You drop a half an interest rate just by that. You go back up to 800, you wouldn't get even better. But if you're in the 680 range, on a 30-year fixed Fannie Mae, you're at 8.5. But I want to show you the difference in FHA, because FHA doesn't hurt as much as conventional when it comes to credit score. So if you have a 680 credit score, look at the difference in rate between 30-year fixed Fannie Mae and FHA. You're almost 1% better based on credit score. I mean, you can go all the way down to 660 and you're still in the 7s. Whereas if you go down here, you're almost 9% on a conventional if you have bad credit. So again, credit scores are a massive part of what rate you get. It's very, very important to have good credit. So when we talk to our customers about boosting their credit scores using my FICO Boost, so you go to www.ficoboost.com. I have a program that will help people boost their credit scores, because getting a higher credit score will make your rate much, much better. So yeah, we don't like seeing these rates, guys. None of us do. It's frustrating. The mortgage industry is just getting slaughtered, and it's really tough. So let's just look to see what's happening this week. JOLTS number, this is our job openings. We're going to really look at this one carefully tomorrow. The Fed spoke today. Again, that's what kind of spooked the markets a little bit today. They are hawkish. Remember last week or the week before last, I said, I hope they're dovish. Well, they were very hawkish, which means they're still aggressively talking about potentially raising interest rates again in November, which everyone thinks is in the cards. So I'm thinking beginning of next year into March is when we're really going to start to see the impact of rates coming down a little bit, or see the beginning of that. But this week is going to be very important, because remember, jobs, if you listen to the radio, guys, watch the news, we want jobs to be less. We want less jobs right now. We want higher unemployment. So we've got ADP private payroll, say that 10 times fast, on Wednesday. We've got job cuts on Thursday, initial jobless claims on Thursday, and then we've got the unemployment rate coming out on Friday. So this week is jobs week. It's going to be really, really important to see this. I'm hoping that we see a little bit of cracks in a job market a little bit, so we can start to see mortgage bonds get some relief. We want mortgage rates to come down, because it is tough. So in this market, guys, still we need to be talking about mortgage rate buy downs. We need to talk about permanent rate buy downs and temporary buy downs, and potentially stacking the both of them. If we see homes on the market for longer than expected during the holidays, this is somewhat of a slow time. We may be able to see opportunity to get the sellers to buy down interest rates. Some builders our advertising rates at 4.99 if you put 10% or more down, if you have really good credit by buying the rate down. You can price your home with a dollar amount that is included that your sellers are willing to give to buy down a rate to a certain amount. If you want to do that and kind of copy what the builders are doing, let me know, because we can calculate how much it's going to cost to get your rate into the 5s or into the 4s for your potential buyer, and we can illustrate that in a potential advertisement. So we're just going to copy what the builders are doing because they already had their attorneys look at it, and we'll see what we can do to help maybe bolster some buyers jumping off of the fence in the next few months. So let's have a look here at appraisal contingencies, because this is a big one, guys. We all want to waive appraisals if there's multiple offers, right? We want to have the strongest offer. We know that this market is unique. We know that there's not a lot of inventory, and if there is a good home, we want to go in as strong as possible. So appraisal contingencies. I have a trick that is very, very unique, where I can actually go into Fannie Mae and Freddie Mac and run the property through their system to get an appraisal waiver before you make an offer. Now, the reason this is a trick is because most companies out there, once you put an address in for a property and you run it through, that initiates the disclosure process. We have a system that basically goes around that to let us run it without triggering a loan application, which triggers loan disclosures, which makes the whole loan process start. And typically, if you're a lender and you start that process, in order to undo it, if it's to change properties, you have to cancel out that loan, redo the loan application, and it's just a mess. We have a way of doing it so you can run it, get the appraisal waiver, and make an offer. And if it doesn't go through, if you don't want that property, it's okay. We don't have to recreate the file. We don't have to go through anything. So it's a really nice trick that we have. And again, most lenders won't do this because it's a lot of work to undo, but we have that little trick. So if you have a customer that is putting 20% or more down, and you want to know if you have an appraisal waiver prior to making an offer, so that when you make an offer, you can waive the appraisal contingency out of the gates, we can do that for you. So just keep that in your little quiver of tricks when you're making offers and there's a loan that's required. Let's get that appraisal waiver. Let's run it through to see if we can get that up front. And that's for any conventional loan only. Remember, only Fannie Mae and Freddie Mac allow for appraisal waivers. Jumbo, FHA, VA, USDA, none of those allow appraisal waivers. So just a neat little trick. Now that we're on the point of talking about appraisal or contingencies, I want to talk about financing contingencies, and same as cash offers when there's a loan. And that's the next screen. So we have a program called the Platinum Loan Approval. And if your customer is willing to go through the whole process up front, that means they have to get me all their documents, get me all of their tax returns, W-2s, pay stubs, everything up front. We will fully underwrite that loan through underwriting, get it fully approved, and get all of the conditions cleared. So the only two conditions we have are appraisal, and if we get that waived, the only condition will be clear title and signing disclosures. So you can literally, on this program, go in, you can waive the appraisal contingency, you can waive the financing contingency, and you can close in 2 weeks. So if you want your buyers to have the best opportunity to win an offer coming in this market where there's very few homes in the market, we want this. We want our buyers to be all in up front. We want to waive the financing contingency if we can, and we want to waive that appraisal contingency. So this, guys, is going to be critical so that you don't have to write 10 offers to get one property once the market turns and rates drop, because we all know what's going to happen. When the rates drop, everyone's going to jump back in the bandwagon and start buying again. And because of our inventory problems, we're going to have multiple offers, and it's going to be very difficult. So we want to really talk to our buyers about this and get them on board with getting everything to us so we can get this financing contingency waived and the appraisal contingency waived. Again, 20% or more down on conventional only. So this is a big trick, guys, to win. Back in 2020 and 2021, we were doing this on as many transactions as we possibly could, and we were winning. And we were beating everyone on offers. It was fantastic. I do believe this will come back as we see rates drop in the near future here. So I think March Madness is kind of when it's going to become the opportunity, the spring buying season. I think a lot of people are going to be on hold through the holidays with rates being where they're at. Let's take advantage of the rate buy downs. Let's really hope we can, I don't know, help as many buyers as we can right now to get a good deal. Because I think when rates are higher, sellers are more willing to make a better deal. But when rates drop, I don't think that's going to happen. So I think it's going to be more bidding over ask, etc. when rates do drop with the inventory issues that we do have. So let me get back in here and bear with me one moment. Stop share. And let me answer any questions that you may have regarding contingencies, because I know there's a lot of hesitation when we do contingencies, especially financing contingencies. So we want to make sure we're on the same page there. But appraisal contingencies are easy. I can run it before, and we can really set you guys up for success on that. So any questions regarding those contingencies, what rates are doing, maybe any unique scenarios you guys are running into when it comes to other lenders, or questions, or any problems with loans that you need help with, I'm here for you today. So let me know if you have any questions in the chat, or just jump right on. Otherwise, you guys have a phenomenal week. And again, I'm going to stay on here for a while. So if you guys have some questions, feel free to express those questions in the chat, or just speak up, and I'm here to help you. But let's try to get those contingencies waived as much as possible, especially when there's so few homes on the market. And be careful out there if you're down in the valley. It is smoky as all get up, and it is gross out there. So I'm not sure what this fire is, but just no big activities outside right now, because it is disgusting outside. I don't know if you guys have seen the smoke outside, but it is gross. All right, guys. Well, enjoy your week, and let's hope and pray for lower rates, because we all need it.